Hey everybody, this is Skip Pulley from Catharzine magazine and my podcast Time in Outer Space and the Soundboy Show. And some of my friends at Anarchist University asked me to create a brief video presentation about becoming your own bank using whole life insurance. I did have a policy of that nature several years ago, and I did successfully borrow against it to pay some bills as well as make some investments. So I have a little bit of experience in this, so they asked me to just tell everybody a little bit about it. And the one thing I can tell you straight away, which is the most important thing about it before I even get started, is the premiums are higher than term life insurance. So if you aren't prepared to pay I don't want to say much higher premium, sometimes it's just a bit higher. But if you can't pay a higher premium, then I wouldn't really recommend this method. But anyway, let's go ahead and get started in becoming your own bank. This is part one in a series of becoming your own bank videos. I believe there will be one on Bitcoin, which someone else will be doing that presentation. I think there's also one on investing. Maybe that has something to do with precious metals. I'm not sure. And also one on savings accounts, which I think I will be taking part in that one as well. I do have some experience in savings account and borrowing against that as well. So they may ask me to say a little bit about that in the future. So let's get started. Using a whole life insurance policy to invest and pay debts. As far as the overview, the benefits of whole life insurance are a guaranteed tax-free death benefit for your beneficiaries, which is very important, cash value that grows at a guaranteed minimum crediting rate with no risk of market loss. So it's in that regard, it's unlike, for example, a 401k. Tax-free growth, tax-free withdrawals, and tax-free loans. Excuse me, annual dividend payments provided your carrier is a mutual insurance company owned by policyholders. So the origins are, it was originally popular with farmers, shippers, storekeepers who sold to farmers on credit pending the harvest, and other people with uneven cash flows. If they saved aggressively within a life insurance policy, they got a death benefit and a ready source of liquidity from loans against the life insurance policy. Since the policy was ultimately secured by the death benefit, it was a safe loan from the point of view of the insurance company. It also meant that if there were a poor harvest, for example, the farmer didn't risk bankruptcy or foreclosure if he couldn't pay back the loan right away. While little understood by mainstream media, the concept has been passed down from farmers to a wide variety of other businesses who use COLI, or company-owned life insurance, as a source of capital to fund operations, pay bonuses, or any number of other uses. Here are the types of permanent life insurance. You have whole life insurance. This type of permanent life insurance has higher premiums than term and has an investment feature called cash value. Your premiums stay the same for the life of the policy. The death benefit is a guaranteed amount, and you get a guaranteed rate of return on policy's cash value. The other types of permanent insurance are variable life insurance, which there's increased risk with variable life insurance because an investment portfolio is tied to the value of the policy. The premiums are fixed, but the cash value and death benefit can fluctuate depending on the performance of the underlying investments. And the third type is universal life insurance, the most flexible form of permanent life insurance. Universal life allows you to make variable premium payments or modify the death benefit more easily than other types of life insurance. The flexibility comes from three parts of the policy: premium, death benefit, and cash value separately. Although this form of permanent life insurance has several advantages, there is a possibility that you won't build cash value under certain circumstances. This is basically how it works. The driving concept is direct recognition, or more precisely, the lack thereof. Here's how it works. When a life insurance company practices direct recognition, they only pay dividends on the cash value left in a policy after any loans are taken out. If you have $100,000 in cash value and you borrow $50,000 against the policy to buy a car, the insurance company will only pay the guaranteed crediting rate and dividends on the $50,000 left over. However, some insurers do not practice direct recognition. They charge interest on the loan, but they do not stop paying the crediting rate and dividends on the money you borrowed against. That difference is key. When you borrow money against a life insurance policy, you are not really borrowing your own money. You are borrowing from the general fund of the life insurance company and using the cash value in your policy to secure the loan. Here is the downside. It works very well for some people, but it is not a magic wand. Even with dividends, which aren't guaranteed, the internal rate of returns available on these policies is very modest, especially in a low interest rate environment. It's not for people who don't need or want a permanent death benefit. It's not for people who can't afford a term premium to protect their families. Expenses are front loaded. The agent and the insurance company can eat up half of the first year's premium. And most importantly, it's especially not for people with an unstable source of income. Here are some potential alternatives. Any decision on the part of a mutual insurance company not to practice direct recognition of loan balances creates a kind of prisoner's dilemma. Policyholders that don't borrow against their policies are in effect subsidizing the activities of those who do, which means that not everybody can take advantage of this strategy and tap their policies to finance large purchases at the same time. The more well-marketed the strategy is, the less effective it will become. Also, not every life insurance agent carries a securities license, which means the only solutions in their arsenal they can present to someone who wants to put a lot of money aside for the future involves overfunding whole life, universal life, variable universal life, or equity index universal life policies.